Thousands of investors hit buy based on a feeling, a headline, or a hunch. But the market requires a cold, mathematical approach. To operate effectively, you need a system. Today, we're going to build your custom trading strategy blueprint, a systematic plan driven entirely by objective data, not emotion. To do this right now, open a blank document on your computer and have your brokerage account ready. We're going to build this roadmap step by step. By writing these rules down, you are actively neutralizing the single greatest threat to your portfolio, your own unmanaged emotions. Step 1. Before we even look at a stock chart, we have to define your personal financial boundaries. At the top of your document, write down 3 metrics: your investment goals, exact risk tolerance, and time horizon. Next, you need a plan for the IRS. Long-term tax implications must be baked right into this foundation. For example, detail your method for tax loss harvesting. This specific technique deliberately sells underperforming assets to offset capital gains from your winners. Locking in these parameters today guarantees that when market volatility hits, you already have a structural plan in place, rather than reacting in panic. Now we need to choose the data engine. This is the specific analytical method that will tell your strategy when to buy and sell. This diagram shows 3 options. Left, technical analysis, uses price trends and indicators like moving averages. Middle, fundamental analysis, screens intrinsic health, focusing on revenue and profitability. Right, quantitative analysis, uses massive datasets and regression models to exploit market inefficiencies. Unlike the other methods, a quantitative strategy processes millions of data points at once, relying entirely on technology to execute trades in fractions of a second. Look at your document and officially commit to one of these engines, or define exactly how you'll combine them. Committing to a single framework keeps you honest. It stops you from scrolling different charts and cherry-picking specific data that justifies a bad trade. Next, translate your chosen engine into strict logic gates. Write down exact if-then rules. If your specific criteria are met, you buy. If a position drops by a specific percentage, you sell. These strict rules protect you from a psychological vulnerability known as the disposition effect, a cognitive bias causing investors to hold losing assets. They hope these assets will eventually bounce back, while selling rising stocks far too early just to lock in a quick win. By strictly enforcing the exit rules you've already written down, you actively override that biological urge to hold on to a sinking asset. That makes your exit rule the most mathematically vital part of this blueprint. It is the single line of code that ensures your portfolio survives a major downturn. Now that the rules are written, we have to test them. First is backtesting, running your blueprint against historical market data to see if it works. As you test, watch out for curve fitting. This shows a trader over-tweaking rules until their strategy perfectly hits every historical peak and valley. But when this over-optimized strategy crosses into live, unpredictable conditions, it completely misses new data. Once you have a strategy that survives backtesting without being forced to fit the data, it's time to move your blueprint into a live brokerage. Here, you have to account for frictional costs. Look at this transaction dashboard. Even a winning strategy can bleed money if you don't factor in the bid-ask spread and brokers' commission fees. Your strategy is only truly viable when its return survives the stress of historical data and the real-world friction of every trade. Look back at your document. You now have a complete strategy blueprint with your personal goals, your analytical methodology, and your precise logic rules fully locked in. Before risking capital, take this blueprint and start paper trading. Use a simulator to test your rules in live market conditions without spending real money. Remember to review this document regularly. As your personal financial goals evolve and market dynamics shift, your strategy will need to adapt alongside them. You are no longer an emotional participant hoping for a lucky break. You have the exact documentation needed to operate in the market systematically, safely, and entirely by the data.